Warren Buffett, often hailed as the greatest investor of all time, has built a fortune exceeding $135 billion through a lifetime of disciplined decision-making, patience, and an unwavering commitment to fundamental principles. His approach to wealth creation is not rooted in complex financial engineering or speculative bets but in common-sense strategies that anyone can apply. At the core of Buffett's philosophy is the understanding that true wealth is accumulated slowly, through intelligent choices, rather than through get-rich-quick schemes. His journey offers a masterclass in financial wisdom, providing key lessons that can guide investors, entrepreneurs, and everyday individuals toward long-term prosperity. One of the most critical lessons from Buffett is the power of long-term thinking. In a world obsessed with instant gratification and short-term gains, Buffett stands apart by focusing on investments that compound over decades. He famously said, "Our favorite holding period is forever," emphasizing that the real magic of investing happens when you allow time and compounding to work in your favor. This mindset requires patience, something many investors lack, but the rewards are undeniable. Unlike traders who chase fleeting market trends, Buffett seeks businesses with durable competitive advantages, strong management, and the ability to generate consistent returns over time. By holding these investments for years, or even generations, he maximizes their growth potential while minimizing the erosive effects of taxes and transaction fees. If you are enjoying this video, please leave a like and subscribe so that it can reach more people, and thank you. Another cornerstone of Buffett's strategy is investing only in what he understands. He avoids industries with unpredictable futures or overly complex business models, sticking instead to simple, well-run companies with clear economic moats. This principle has saved him from countless financial pitfalls, as he never risks capital on ventures he doesn't fully grasp. Many investors lose money by chasing hot sectors or speculative trends without truly understanding the underlying business. Buffett's approach is the opposite. He waits for opportunities where he has deep conviction, ensuring that his investments are based on logic rather than hype. This discipline has allowed him to avoid disastrous bets while capitalizing on high-probability opportunities. Buffett's concept of intrinsic value is another foundational lesson. He doesn't buy stocks based on their market price alone. Instead, he calculates what a business is truly worth based on its cash flows, assets, and long-term potential. When the market undervalues a strong company, often due to temporary setbacks or irrational fear, he steps in to buy at a discount. This strategy, known as value investing, was pioneered by his mentor Benjamin Graham, but Buffett refined it by focusing on high-quality businesses rather than just statistically cheap stocks. The key takeaway is that successful investing isn't about predicting short-term price movements but about recognizing when a business is selling for less than its real worth. This requires rigorous analysis, independent thinking, and the courage to act when others are panicking. A lesser-known but equally important aspect of Buffett's success is his aversion to debt. While many investors use leverage to amplify returns, Buffett understands that excessive borrowing can lead to ruin. He has always prioritized financial stability, ensuring that Berkshire Hathaway maintains a strong cash reserve to withstand economic downturns and seize opportunities when others are forced to sell. This conservative approach has allowed him to navigate crises, from the dot-com bust to the 2008 financial meltdown, without suffering catastrophic losses. His lesson here is clear: debt can be dangerous, and true wealth is built by staying solvent through all market conditions. Emotional discipline is another hallmark of Buffett's investing style. The stock market is inherently volatile, with prices swinging wildly based on fear, greed, and speculation. Yet Buffett remains unshaken, viewing market downturns as opportunities rather than threats. He famously advised investors to be fearful when others are greedy and greedy when others are fearful. This contrarian mindset allows him to buy undervalued assets during crises while avoiding overpriced bubbles. Many investors fail because they let emotions drive their decisions, selling in panic during crashes or buying into manias at peak prices. Buffett's success proves that mastering one's psychology is just as important as mastering financial analysis. Equally critical is Buffett's emphasis on management quality. He invests only in businesses led by honest, competent, and shareholder-friendly executives. A great business can be ruined by poor leadership, while a good management team can steer even an average company toward success. Buffett looks for leaders who think like long-term owners rather than short-term profit maximizers. He values integrity, rationality, and a focus on sustainable growth over flashy quarterly earnings. This lesson extends beyond investing. Whether you're building a business or managing your own finances, surrounding yourself with trustworthy and capable people is essential for long-term success. Buffett's personal frugality is another surprising yet instructive aspect of his philosophy. Despite being one of the richest people in the world, he lives modestly, still residing in the same Omaha home he bought in 1958. He avoids lavish spending, understanding that wealth is not about displaying status but about preserving and growing capital. This mindset reinforces the idea that financial freedom comes from disciplined saving and smart investing, not from extravagant consumption. Many people equate wealth with luxury, but Buffett proves that true financial security comes from living below your means and letting your money work for you. Unlike conventional wisdom that promotes extreme diversification, Buffett believes in concentrated investing. He prefers to put significant capital into a few high-conviction opportunities rather than spreading his bets thinly across dozens of stocks. This approach requires deep research and confidence. But it also allows for outsized returns when those investments succeed. Many investors dilute their gains by over-diversifying, ending up with a portfolio that merely tracks the market. Buffett's strategy shows that real wealth is built by focusing on your best ideas and avoiding mediocrity. Finally, Buffett's commitment to lifelong learning is a lesson in itself. He spends up to 80% of his day reading, absorbing knowledge from books, financial reports, and industry analyses. He believes that the more you learn, the better your decisions become. This intellectual curiosity has kept him ahead of market trends and allowed him to adapt over decades. In an ever-changing world, continuous learning is not optional, it's a necessity for sustained success. Warren Buffett's wealth-building principles are deceptively simple yet profoundly effective. They require no insider knowledge or complex strategies, just patience, discipline, and a commitment to rational decision-making. By embracing long-term thinking, understanding intrinsic value, avoiding debt, controlling emotions, and investing in quality businesses, anyone can apply these lessons to their own financial journey.